Hello, everyone, and welcome to today's Hangout. I am Barbara Semeraro, alongside Brittany Brewster, our membership director, and I don't believe Miriam Fairchild, who is our membership coordinator, and we're hosting today's Hangout. So about a month ago, I fielded a phone call from an unknown number, and the caller wanted to know more about HFTP, and I was happy to explain to her about HFTP. But during our conversation, Gisela mentioned ERC, and you know what? I knew what that reference was because in early 2021, we did have a Hangout when this program first came out, and I thought, oh, this is a wonderful opportunity to bring back this topic to have a follow-up discussion. But this time around, we have a speaker with a company whose focus is on advising employers on how to recover the maximum amount of ERC credits under the IRS guidelines. So today's Hangout, Employee Retention Credit COVID Relief Program, will touch upon qualification guidelines, reporting period, and required documentation, and a lot more. Gisela graduated from the University of Miami with an undergraduate degree in international finance and marketing and a master's degree in business administration. She began her career in banking by joining the management training program at a Federal Reserve Bank, where she gained extensive operations experience. Now, after several years, Gisela decided a change was needed and proceeded to switch to commercial banking with a concentration in the lending field. She enjoyed assisting many companies with working capital lines after conducting extensive financial analysis and presenting loan committees with candidates worth of evaluation. Eventually, she became in charge of an entire commercial loan department. Now, given the very structure and the nature of banking, Gisela made a further change and developed a new and rather fruitful career in sales and marketing, primarily in the financial services field. So, Gisela Zarco is the Senior Vice President of Business Development at Macmore Capital. And Gisela, I now hand over the Hangout to you. Welcome. And you're on mute. Ask to mute. Yeah, you're on mute. Where'd she go?
Can you hear me now?
Yes.
Okay. Hi. Good afternoon, everyone. Thank you, Barbara, for the introduction and for assisting me in coordinating this HFTP Hangout session. I appreciate it. Again, my name is Gisela Zarco of Macmore Capital, and I'd like to welcome each and every one of you, hoping everybody's doing well. And I assure you that you'll do even better once you learn about this wonderful ERC opportunity. My goal today is to inform you, or possibly enhance your knowledge, depending on whichever may be the case, of the COVID Relief Employee Retention Credit Program, otherwise and more commonly known as ERC. Before I do, I'd like to share some highlights about my company, Macmore Capital, that will allow you to understand how and why it was rather seamless for us to transition and naturally gravitate towards focusing on this ERC program and applying so many of our physical and human resources at this time, almost exclusively for this purpose. Macmore is a class action claims recovery firm. We have assisted a multitude of companies over the years in maximizing their fair share of settlement monies from class action lawsuits, of course, only once the settlement has been reached. Now, in order to facilitate a process that requires a whole bunch of due diligence, precision, and so on, we came up with a rather enriched infrastructure to facilitate this, be it a legal team, financial professionals, data processing experts, and, well, a lot of research specialists as well. We've assisted via this process a multitude of companies over the years, and they've been very satisfied to the extent that these companies did not have to incur an expense for filing, tracking, and claiming refunds, and why we were able to transition so easily to the ERC project. The most important and pertinent change that I believe we made in favor of this project particularly was to engage a CPA firm that decided to segue in a manner that they have strictly ERC specialized CPAs who devote their time exclusively to this project. And frankly, this is what I think sets us apart from the rest. And what has allowed me the grand privilege of being able to absorb so much of this information that I truly look forward to sharing with you all here today. I've also had that privilege with accounting firms, CPAs who are in fact generalists. My colleagues and myself have connected, if you would, on a nationwide basis with many, many CPA firms who have humbly admitted that this is not their forte. They don't have the infrastructure, they don't have the manpower, the time, or the facilities. And in the spirit of the maximizing results for their clients, they have in fact teamed up with us. So what I do want you to understand is that I'm going to go into some detail, and by no means do I expect any of you to absorb the majority of this in any sort of detail. This is only intended on my part as an orientation. And if any of this criteria was to resonate in some sort of fashion to any extent, and you believe that you could be a possible candidate, well, then by all means, you can log on to our website and gain some further knowledge for your own education, if you would. So let's start out with the basics. What is ERC? Well, it is simply a refundable and advanceable tax credit for small companies and small mid-sized companies that were able to retain 500 employees or less during the COVID period. And the credit is calculated on the number of qualifying W-2, I want to emphasize that, strictly W-2 employees during that time period, be it that they were part-time or full-time. If eligible, businesses can claim the ERC for qualifying wages, and I will repeat this, between March 13th of 2020 and September 30th of 2021. So again, this covers 3.5 quarters of 2020 and 3 of 2021. So the maximum potential time period that one could qualify for would be around 6.5 quarters between 2020 and 2021. Now, a very logical question, and we're asked often, how do I know if I qualify? What qualifies me for ERC? Well, before I get into what I would consider to be the basic parameters, I'd like to share something that I'm going to redundantly express again. And that is that these particular parameters that I'm about to share with you, yes, they're the most basic and solid parameters. But we have found over time, folks, that if your company was hurt in any fashion and to any degree by the pandemic, you will probably be entitled to some degree of credit. How much remains to be seen. So again, this is all in our website, and I'm going to go over what I thought was most fundamental, and even more importantly, the most basic and applicable. So in order to qualify for ERC in 2020, the business had to have experienced either a 50% drop in their gross receipts during any quarter in 2020 over that same quarter in 2019, which is prior to COVID, or they would have had to have been mandated a full or partial suspension of business operations due to the government order. One or the other would suffice. I've known clients who have only been able to qualify via that partial or full suspension, and they did not qualify in any matter, shape, or form financially, and they were able to benefit. not to the extent as others, but they were. Now, things became, let's say, more attractive in 2021, whereby doing any of the qualifying quarters, a company would have had to have experienced only a 20% drop in business over that same quarter in 2019 in order to qualify, or, as I described earlier, a full or partial suspension of business operations due to a government order. So to recap real quickly, in 2020, 50% over the same quarter in 2019 and a government suspension. In 2021, 20%. There's also criteria that applies in, I would say, probably a much more remote scenario, because what I'm about to describe, I would think that a company would have had to obtain some sort of assistance very quickly in order for them to have even stayed alive in this scenario. And it follows. They would have had to have been extremely and severely affected to the tune of a 90% decline in business over that same quarter in 2019. And in this case, all wages could be included. And this brings me to a point. Let me clarify, because I didn't state this previously. What this means is that anyone could qualify, versus, who they retained obviously, versus the scenarios that I described earlier under the 20% and 50% parameters, whereby family members, folks, are excluded. So the owners, close family members, be it spouses, children, parents, and I believe even aunts, uncles, and cousins who work within that company cannot, those folks cannot be applied, for the purposes of enhancing this credit. There's one last category, and it applies to strictly quarters 3 and 4 of 2021. And this would qualify a startup operation that began after February 15th of 2020. They would be eligible for a maximum of $50,000 per quarter and would not qualify under either the suspension or the gross receipts decline parameters that I described earlier. That's the qualification portion of this in somewhat of a simplified fashion, but I think it encompasses for sure the most, should I say, parameters under which companies have qualified. But I do want to reiterate that they may not necessarily fall under any of these guidelines, and there still may be an opportunity for them to qualify somehow. You may also ask, how much do I stand to get back? And I would not begin to even suggest a number, but what I would like to share with you is the ultimate and, let's say, utopic potential of this program in terms of the maximum. And then I'll be happy to give it a practical spin and tell you what I've seen from the fruitful gains of my clients thus far. In 2020, the maximum that was allowed was $5,000 per employee for the entire year. However, in 2021, things became much more attractive by comparison, and the government decided to open up the gateways, if you would, and they allow $7,000 per employee, per quarter. And being that there are 3 qualifiable quarters, you take the 7,000, you multiply by 3 quarters, that's 21,000. And you add the 5,000 from the previous year, which was the maximum, and that would give you a maximum potential of $26,000 per employee for this purpose. Now, perhaps my bad, I can't tell you if I have any clients, even if they gained hundreds of thousands and frankly in the 7 digits, I can't tell you whether or not any of them, whether that resulted, if you would, from that maximum gain. I can't. So I could certainly circle back on that if anyone has that curiosity. What I can tell you, because I paid attention, is that the minimum that I ever witnessed was probably somewhere around $5,000 to $7,000 per employee. And I think a fair average is around $10,000 to $12,000 to $15,000 per employee. I don't think that the bare minimum is common, nor do I think that that maximum of $26,000 is common either. I think the law of averages of statistics applies here too. And I think that an average of about 10, 12, 15,000 is fair. And the low end that I've seen is around 7,000. So that's the deal there. Now, I'd like to share that the amount does vary tremendously in a manner that it's really been all over the board. And the reason for that is that there's so many contingencies that affect that ultimate credit amount. So I wouldn't even be daring enough to come up with all of them, but I'll give you some examples that I think are very applicable. For instance, the timing of the company's revenue declines is very, very influential. Receipt of PPP loans and the forgiveness. Employee turnover. And again, an array of other factors. And frankly, our ERC, very dedicated staff of CPAs, have to first engage in a multitude of calculations, take many, many factors into consideration before they derive at that final tax credit estimate. So to conclude, I'd like to share that the unfortunate reality is that the government has in fact allotted billions of dollars in economic stimulus through the ERC program. Yet it's sad, but it's our belief that millions of business owners may really just let the stimulus relief go unclaimed, which to me is senseless, really. I'm sure that many of you have heard conflicting stories about whether you qualify, eligibility, lack thereof. But I want to assure you that if your business suffered to any extent during this pandemic, in any fashion, you're owed a check from the US Treasury for hiring and retaining American workers during this pandemic. There's no doubt about it. The only question is how much, and that honestly remains to be seen. But perhaps it's more than any of you ever anticipated or even knew you had the opportunity to procure. Now, it's my understanding that many of you are part of the hospitality industry. And I like to share that industry, alongside gyms, yoga centers, places like that, where the opportunity, if you would, if the possibility rather, that's hardly an opportunity, if the possibility of becoming infected was, heightened given the environment, hospitality is one of them. Look, folks, we're in Florida, in a state where everyone that is influential tried to keep the economy going and thriving. And even here, I don't know of a restaurant, for instance, that was not mandated some sort of closure or some sort of alteration in their business pattern that did not affect them anywhere from severely to mildly. Best example I can give you is that some restaurants were mandated a full closure, and others, for instance, were told that they could not have dine-in services anymore. They can only conduct business via deliveries and pickups. That affected them tremendously. And then when they were allowed to reopen, it was in a very progressive fashion, strictly outdoors, in an incremental fashion, first 25% capacity, and so on up the line until they reached some semblance of normality again. A lot of these clubs that you folks are part of, correct me if I'm, you correct me if I'm wrong later, golf clubs, swim clubs. I've been to several golf clubs here in Florida, and I don't know one that doesn't have some sort of eating facility, be it a full-blown restaurant or otherwise. So again, it would be highly, highly doubtful that you folks in particular wouldn't have been affected in one fashion or another. And I advise you to take advantage of any opportunity that you may have, that may have resonated here. If the light bulb went on here at some point or another within my discussion, I hope it has. If you're a bit more learned on ERC than you were before you signed in some minutes ago, and I'm hopeful that you are, then I feel that I've done my job. And I thank you so much for the opportunity. And I hope that you proceed to obtain more knowledge and take the appropriate steps to give your employers or yourselves, whichever may be the case, the opportunity of something that you're lawfully entitled to. And I don't see a reason why you would not want to gain the benefit. That's the deal. and I'm open to any questions that any of you may have. And I promise to answer to the best of my ability. And if I'm unable, I will look into it for you. How about that? Barbara, thanks again. Brittany, thanks again. I appreciate it.
Wonderful. So if anyone has a question, feel free to unmute your mic or go ahead and put it inside the chat feature. Hopefully you can also see the contact information if you want to have a discussion directly with Gisela. There's her information. So there was, if somebody already filed for the, what was it, the PPP, are they also through the same time period eligible for the ERC?
Absolutely, absolutely. ERC was part of a revised portion of the original CARES Act where they had to choose one or the other. I would say that the overwhelming majority of our clients have in fact already benefited from PPP, pardon me, the majority from both rounds. And most of them were, the amount was forgiven. Because unlike ERC, which is a grant and does not have to be repaid, PPP is a loan, but most of them were forgiven. And in fact, it became as good as a grant for them. Yes, ma'am.
Okay, so for that quarter or that 8 months or 8 weeks, because that was one of the comments that I was hearing, is that yes, we took advantage of the loan, and so therefore we're not eligible for the ERC during the time that we took the loan, but now we could backdate it.
Yes, ma'am. Yes.
Okay. Perfect.
Yes. There are absolutely no exclusions. There are no deviations from all that one is entitled to under the ERC because they had engaged in PPP. Let's put it that way.
All right. Let's see. I do see that Kim has her hand raised. Kim, do you want to go ahead and unmute or put it in the chat to ask your question?
Hi there. So my
Hello.
question is, hi there. My question is for 2021.
Yes, ma'am.
As we are a club and we have dues flowing in, the 20% reduction in revenue, is it inclusive of all types of revenue for the club, or can it be specific to outlets? Like we saw a big decline in our private party events, as well as a la carte dining. But, do they actually segregate out the different revenue areas, or is it the club's?
No, ma'am. No, you're one institution, and under your umbrella, you have these different venues or what have you. This is an aggregate. This is on a consolidated basis, rather, not on a consolidating basis. This is a consolidated scenario of everything, of all the revenues that fall under your umbrella.
Understood. Okay. So, okay. I had been hearing that it was segregated, but okay. Good to know. Very good.
No. That's not my understanding. That's not my understanding at all.
Thank you.
Of course.
Mm-hmm. Let's see the next person. Jonathan Goodman has his hand up.
Okay, is there a difference between for-profit and not-for-profit companies? Is this, in other words, is this an employee? Is this a payroll tax credit, or is this an income tax credit?
Both. In other words, I mean, nonprofits can benefit the same way. We've had nonprofits that we've represented.
Well, no, I'm just wondering, is the credit like an income tax credit? Because
yes,
of course, most of us don't pay income taxes.
It's a tax credit.
All right.
All right. Does anyone else want to raise their hand or unmute to ask a question? Or
Barbara, I want to add something. Are you there? Yeah.
I'm just putting your contact information in the chat so people have it. So
yeah, I appreciate that. No, I don't know if Jonathan is sure. Maybe I didn't answer to full satisfaction there. I mean, nonprofits, because we've looked into this before, are dealt with in the same manner as as profit companies, this is a payroll tax credit. I mean, employees at these nonprofits get paid. So it is a payroll tax credit.
Let's see, we do have another question from Maureen, and she asked, if you are already filed for the ERC, are there any other new credits? Can you file multiple times? I mean, like you only filed for 2 quarters, but now it's 3 quarters. Can you file for that last quarter?
Well, I mean, you can file for as many quarters as you're eligible for. So if you filed for 2 of the conceivable 6.5 quarters that you could potentially qualify for, and you realize that, you can certainly file for the remaining quarters, if that's the question. Sure.
Mm-hmm.
Sure.
Were there any? Oh, go ahead.
I'm sorry. No, the way we do it is that we ask for what we ask for, and our ERC specialized CPAs become very resourceful in that they have all the payroll journals, etc. And in our process, all the qualifying quarters are determined. Now, if for some reason in this particular, there's an instance where it wasn't done in that sort of, let's say, professional, comprehensive manner, and it was done in some sort of bits and pieces, and okay, well, we'll include these 2 quarters, and they're cognizant of the fact that there are quarters remaining that qualify, well, by all means, sure.
Let's see, we do have, looks like Melissa Angelo.
Yes, hi.
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 So I just want to revisit the PPP versus ERC. So I realized that if you did get the PPP loan, you are able to participate in the ERC, but I do not think when you are submitting your wages to be for the ERC credit, I don't think you can use the same periods that you use for forgiveness to get that credit. If I'm wrong, that's great news, but in our case, I needed to use about 9 weeks worth of payroll, actually, yeah, 9 weeks worth of payroll to get our PPP loan forgiven. And I'm preparing my ERC credit work papers now, and I'm excluding those 9 weeks from the credits that I'm going to submit to our payroll company. Am I incorrect in that?
I know that having received PPP does not exclude your ability to get ERC. That is I'm 100% positive about.
Right.
To be honest with you, you've got me wondering a bit. I would want to double check on that.
Okay.
I have Elio. Is there any way that you can, yes? Do you know something on this further?
Yes. So can you hear me?
Mm-hmm. Yes.
I know that there are exclusions for time on the PPP loan and forgiveness. I still have yet to understand exactly which period is qualified against what, so I don't want to speak too soon. I know that she's onto something when she's saying she needs to exclude some of those weeks. But again, that's something that is, entailed that our CPAs are always taken care of, and, something that we don't really delve into. So, but yes, there is a time that's excluded.
Okay,
We
thank you.
can find out more. I mean, if you're going to be in touch or whatever it is, we can ask our CPA and he'll shed some light as to exactly what's happening with that. Yeah, that shouldn't be a problem.
That would be great. I mean, based on the latest literature I've read, that you do need to exclude any time that you used to get forgiveness on PPP. So just wanted to confirm. Thank you.
Yeah, absolutely. And if it is in its entirety, then that's a point I missed out on. I mean, again, we turned this over to our CPAs, and they're the ones that, handle all this, all these intricacies, if you would. But the good news, via the revised CARES Act is that, having had one does not exclude the other. And whether you have to exclude the time period in its entirety is, it remains to be seen. You could certainly contact me and I'll be happy to get you that answer by as soon as tomorrow with certainty.
Wonderful. Thank you.
Of course.
Let's see, it looks like Jess Finelli, you have your hand raised.
First of all, when we receive employee retention credit from IRS, and can we recognize as other income in the financial?
I had difficulty hearing her. I apologize.
Oh, when we receive the employee retention credit, can you, you cannot hear me?
We
No, I
can
can
hear
hear you
you.
now.
We can hear you.
Okay, when you received employee retention credit check from IRS, so can you recognize as other income?
So you're asking about the accounting side, once you receive the check,
Yeah.
how do you record that on
Yeah.
your
Yes.
books, so to speak?
Right. Yeah, go ahead, Ellie.
My understanding of that is when, and don't quote me on anything, because again, every company and the way they file their taxes and depending on their tax brackets and call it what you will fall under its own umbrella, so to speak. But from my understanding is that when you receive a check, it's a credit towards taxes that were done, let's call it in 2020 or 2021. It goes back to that year and then applies to that year. So you're not going to take that money and dump it back into that year. You're just going to take away from that year the benefits that you had. Okay, so the benefits that you had from those, you know, from your tax program or whatever it is. But it really does depend. That once that happens, it's your own accountant that's going to really, you know, tell you how to move forward and what we're going to do here as far as do you have to pay anything or do you have to pay anything in arrears, I should say, and things of that nature. That's all.
Okay, so second question is, if you go to IRS website,
Yep.
American Rescue Plan Act of 2021. So basically, you know, it's describe all this, you know, employee retention credit, and under eligibility requirement, it says for the third and fourth calendar quarters of 2021, amended to make the credit available to recovery startup business.
Right.
Employers who otherwise do not meet eligibility criteria. But in the PowerPoint, it says, you presented, it says the retention period is from March 13, 2020 through September 30, 2021. So it includes third quarter. And a lot of companies are not startup, right? So I just wondering, this covering period, it's not only for the startup business, just like IRS said, or it applies to any businesses, already existed before. I just want to clarify third quarter for the 2021 employee retention credit eligibility.
It's kind of like I said, it's the other way around. And it only applies to those 2 quarters of 2021 in the case of a startup that started after February 15th. That is who that applies to.
Taking care of any trade. Okay.
May I speak for a second?
Sure.
Yeah, it basically what she's saying is that any established business that's been around prior to the pandemic qualifies for any quarter beginning March 13th, 2020 and ending September 30th, 2021. The other scenario with the last 2 quarters is only applies to startup businesses. Is that what we're saying, right?
Yes, that's exactly what we're saying. Correct.
I'm curious about third quarter of 2021.
That's included in any business that has been around prior to and through the pandemic.
Okay.
Yeah. This first, second, and third quarter.
And third quarter. Okay.
Correct.
It says third and fourth quarters of 2021. So I just.
No, that's only for a startup.
Only for the, okay.
Right. It's only for a company that started after February 15th of 2020, I guess, because they just started, in essence, not even 2 years prior, they're allowed that extra quarter under those guidelines that I suggested before.
Okay, so
Correct.
whatever businesses already existed before pandemic, they can apply employee retention credit up to third quarter of 2021.
That is correct.
Okay.
Co-
Okay.
Starting with March 13th of 2020. That's why I said it's 3 solid quarters of 2021 and 3.5 of 2020, making for a maximum potential of 6.5 quarters for companies that suffered throughout under those particular guidelines of declining gross receipts by those percentages.
Okay, it just got me confused whether it's only third and fourth quarter of 2021 is only applied to the startups, so.
Yes, ma'am, that's precisely right. Correct. Correct.
Thank you.
Of course. Thank you.
Okay, and then we have another, Jonathan would like to have a follow-up question. Jonathan?
Yeah, I just wanted to follow up from a previous question that was asked because, as you know, I must field 5 or 10 calls a day about this. And very often we're told that you only had to experience a drop in one line of your business. Now, I could swear you said it's your whole business.
You want me to get it?
Yeah.
So what's called a business interruption, okay, goes a long way here. Even if you didn't drop any revenue in any sector of your business or any type of business or your business in its entirety, even if you made more money through COVID, I've had qualifications happen because of business interruption. So if you have a manufacturing plant and you had to 6 feet social distance and everybody had to wear a mask, and you couldn't allow anybody from the outside in unless they were working that day, but yeah, and you had, let's say, 2 people on, your one production line instead of 4, but yet you made more money during that time because you were so busy because you were delivering to supermarkets. You still qualify. You qualify because you had a business interruption, and if you wouldn't have had those interruptions, you probably would have made X amount of dollars. So bottom line is you can qualify under for any of those reasons.
Elio, excuse me for a second, because Mr. Goodman has chimed in based on a previous question that was addressed. I don't know if you heard it, and I hope I didn't misguide. That was my understanding based on one of my recent clients in terms of feedback from our CPAs. Her question was, I believe she's part of a club here in Florida. Her question was, if there's different segments to her business, does the 20% or the 50%, in other words, if she only had a drop in one segment of the business, let's say catering versus whatever,
I understand.
will that qualify her for that segment of the business? And it was my understanding that it's on a consolidated basis. That a company has to meet that criteria, those percentages, where there is a net 20% drop. There could have been a drop in one, a gain in another, but where the net on a consolidated basis has to meet those parameters. I don't know if that's wrong, then I apologize. That was my understanding.
There is a possibility that can happen if there's a way to completely segregate one revenue from the next, which in most cases is very difficult to do. But in their case, if they have a club and they have a restaurant and they're 2 completely different,
entities.
Well, almost an entity.
Not entities, segments of the business or departments or whatever.
That's a possibility. But let me just tell you this, that if someone has a club and they could not serve dinner inside their club and did not have any revenue drop, in most cases, they will qualify. That is a partial shutdown. That's all it is. It's a partial shutdown. It's not a complete shutdown, but if you can't go into the locker rooms, or you can't walk down the hallway, or you can't enter the building, or if you cannot serve lunch at a certain time and you have to social distance, and again, any interruption that comes in there, that is all qualified under a partial shutdown, and you will qualify.
And that goes back to my point that a partial shutdown of any sort, can supersede not meeting financial qualifications. I'll give you an example. A car wash client that I just procured not too long ago. He explained to me that he was mandated to strictly be able to do exterior cleaning, no detailing, no inside cleaning. So the majority of what he normally does, you know, an average ticket of $60, it became $10. And that went on for not a very long period of time. And I'm told that he's going to get back a credit. How much? I have no clue. So I don't need to be evasive with my answers. It's just that there does exist a gray zone here. And that's why I kept emphasizing that there's so many variables that could affect. And that if in fact, you know, you don't meet the basic criteria, there could still be an opportunity that you could benefit from this program. Because we've seen it all across the board and so many different variables affect and so on and so forth.
Let's see, I think we have time maybe for 2 more questions. And I do see that Kim, you have your hand raised. Do you want to go ahead and ask your question?
Yes, so I was the one that was asking about the revenue. So most country clubs have the dues line item, and then we have our food and beverage operations, and we have golf course operations.
Sure.
We have our yacht club. So the food and beverage operations for the clubs, I'm sure were mostly impacted simply because we couldn't utilize, you know, the spacing that was required. So that is kind of where I think that, I guess we're not really looking to the revenue, we're really looking to this other avenue to get in the year 2021. 2020 is a given, I believe, for most clubs.
Yes.
Especially if you're in Florida. We were, you know, there's mandates out there from Governor DeSantis about what the closures were. The question for me is, have you all been audited in any cases of the partial shutdown or the numbers in 2021 that maybe don't have a mandate that we can print out from the Florida, you know, whatever was putting those guidelines out at the time? I mean, we were not allowed to in 2021. You know, we had to space people out. People had to be, we were only seating like 4 to 6 people at a table. Private events were definitely affected. You know,
Sure.
we couldn't do proper spacing. So have you had anybody who claimed those numbers and those monies in 2021, and have you been audited, and what have the results been?
No, ma'am. We have yet to be audited. And what I can tell you is that we have a tremendous research team that searches, and they come up with very founded evidence to be able to proceed, you know, to use that as their basis for the credit. I mean, it's specific. They're cited in a very, very specific manner within a certain, you know, city, within a certain county, and you know, they don't proceed to qualify anyone, particularly on this kind of basis, without there being very solid evidence that it's, you know, that's what occurred, and that you know that the entity was affected during a certain period of time. It's very specific and very well founded, is what I can tell you to the moment, of course.
Okay, thank you.
Yes, ma'am. Of course, of course. You're
Oh, real
welcome.
quick, one more question.
Yes,
On your contract, if we go with Macmore to process it for us, is there defense coverage in the contract?
defense coverage?
Yes, with regard to, you know, I assume that it's a contingency basis fee that we'd be, you know, assigning to you, and would you, if the IRS does audit us?
Oh, yes, we take auditing responsibility.
Okay.
Yes, ma'am.
Thank you.
We most certainly do.
Thank you.
So far, so good.
Okay, and for our last question, we'll have probably a follow-up from Melissa.
Yes, thank you. So just kind of piling on to what Kim was talking about, it is important to know first what revenue we can stratify if we can or not, because I'm also in Florida, and the state mandates went from 3/27/20 through 10/9/2020 per my research. So that leaves me only eligible for 2020. Because if I take my overall revenues, because of dues, we didn't see a 20% drop in any given quarter in any of those time periods. But if we can stratify to just food and beverage, for example, I probably would qualify for some quarters of 2021. So it actually makes quite a big difference. It's not just we had a mandate for part of the period, but it's still, we're talking about lots of payroll dollars that I could gate in, or payroll taxes rather, if we're allowed to stratify. So I think that's why we were really pressing on that question, because I've heard conflicting guidance on that as well.
Yes, as do we. So what we have learned is to segregate our responsibilities in respect to this program, and we take it very seriously, and let the CPAs do their thing. Now, does that mean that we don't ask questions along the way? Yes, but it seems to be contradictory at times, and that's why I suggested there's gray zones. But look, to me, and Elio, I don't know what you think. To me, there are two major things here that I want to seek clarification from our CPAs, and it's twofold. It's this scenario, because it's huge. It could be very impactful one way or another, is what Melissa just addressed in terms of just, on an individualized basis, or is it in aggregate? And then also whether the entire PPP period that the company benefited from, that period in its entirety get excluded from the ERC, right? That was pretty much the question.
Yeah, it was the period rather that you used for your PPP forgiveness. You had to
exactly
specific payroll data to get.
Yes, ma'am. Yes. What I always paid attention to is the fact that the original CARES Act they were exclusive. You could either benefit from one or the other. We just knew that the ERC, that the PPP does not exclude the ability to get ERC, and quite frankly, how much, unless it's in its entirety, which is what you're saying, of the PPP has to be excluded, is something for us to definitely verify. No question about it. And we will. And you're welcome to contact me so I could clarify this for you.
Wonderful. Thank you.
Of course.
Okay. Yes, we are coming up to 10 minutes before the hour. So I was just wondering, Gisela or Elio, do you have any other closing comments that you'd like, or for the audience? I know you kind of summarized it there with the two action items that you're taking back.
Yeah. I would just like to re-emphasize something. I don't think I'm going to be saying anything that I didn't already share. But the only thing that I like to re-emphasize is that don't assume that you don't qualify. It's as simple as that. Yeah, I grant you that he may be based on one of these partial suspensions, and the reward, if you would, won't be as great as if that were the case combined with financial qualifications. But guess what? However much or however little, and that's very personal, I mean, is more than you folks we're counting on or betting your chips on. So I say that if you see any which angle based on what I've explained, by all means.
Hello? Oh, I think we might have lost her audio. And
I think she froze.
yes, I think
Something
so.
just happened here. I apologize. Something happened. I'm sure glad that whatever happened here, it happened at this juncture, so we're just about done. But
that's
all
right.
I have is that I thank everyone for participating. I hope that something was gained by way of knowledge, that it opened up, some, I don't know, some thinking, and we're here to assist in anything you may need.
Well, great. Yes, we put your contact information in the chat, and the chat should be available to everybody who attended today. And I wanted to thank you for coming on to speak about this topic. I think it was a great discussion was had here.
Thank you.
So
I hope
a lot more information as we have worked through this, last couple of years. I'd also like to say that we're going to begin the 2023 year with a webinar on global wages and benefits survey results. And then we're going to follow it up with a Hangout on ethics. And then, of course, we're going to launch our much anticipated 2023 Leadership Excellence Series program. All those registration is available for all those programs. It is on the HFTP Virtual Education webpage. And do remember that the Leadership Excellence Series program is limited to 100 current HFTP members in good standing. So with that, I'd like to close the final Hangout of the year 2022. Thank you all for attending. Have a wonderful and safe and healthy holiday season, and see you next year.